Welcome to Multifamily Insights. I'm your host, John Casman, and I want to thank you for joining us for another great episode. If you're enjoying this show, I need you to do me one quick favor. Leave us that rating and review. We want to hear from you and understand what's working, what you love about the show, but also take any feedback on anything we can do to make you work harder for your investing goals. And if this is your first time listening, be sure to hit that subscribe button so you don't miss an episode. Now, we've got a good show today. We're going to be talking to Joel Friedland. Right out of college, Joel Friedland went to work for a family real estate business in Chicago, where he was mentored in all things real estate. After some time, he broke away from that company and he started his own brokerage business. Eventually, he sold that business to a large company, and it allowed him to focus on his own portfolio of industrial buildings. Now, the last 40 years, he's been directly involved in nearly 100 acquisitions, totaling around 3 million square feet. These days, he manages his existing industrial portfolio of 16 Class B and C buildings and growing a 200-person investor base. Let's welcome to the show, Joel Friedland.
Hey, John. Nice to see you.
Excellent. Listen, it's great to have you on. I went over your bio at a very high level. Why don't you take 2 minutes and fill in some of those gaps?
Sure. When I graduated from the University of Michigan, I knew I wanted to go into real estate, but I had no idea how to do it. So a friend of mine had a jacuzzi encounter with this old guy. This old guy was 63 years old. By the way, that's how old I am today. But he was an old guy. And my friend said, you ought to talk to this guy if you want to get into real estate. He's in industrial real estate. And I said, great. What's that? I had no idea, because I knew about multifamily and residential and retail. And so I called this guy on the phone, a cold call, and I said, hey, you met my friend Mark in a jacuzzi. I'm looking for a job. And he said, can you come in today? And I literally drove to his office, and I met with this guy and his sons that day. And I sat with them, and they said, we need you to be in property management. And I said, sure, property management. And one of the sons started talking to me, and he said, hey, Dad, this guy belongs in sales. He should be in brokerage. And they started arguing about which department I was going to work in. And so the guy in management got me for a week, and I hated it. Property management is nothing but details, and it's hell to me. Some people love it, but I wanted to be in the sales side, and I figured that out, and so did they. So I became a broker. It was 1981. The recession was terrible at that time. Interest rates were 17%. They had 9 empty buildings, and they sent me door to door cold calling and tried to figure out if I could find tenants by stopping in at companies and asking if they would consider moving. So I'd go into a place and say, hey, we've got a building down the street. Would you consider moving? And I was pretty good at it. And I made 37 leases in my first year.
Oh.
And I was just flying high. It was a fantastic experience. I loved it.
I love it, man. With those buildings back then, you made 37 leases. What was the rationale for them to move, right? Especially if it's just down the street. I mean, were you just giving them a lower rent, or what was kind of the sales pitch there?
Well, industrial is a local business. Companies need to stay near where they're at today. And the reason is because industrial buildings are full of distributors and manufacturers. So in the front of a building, they have offices where they have the sales and the accounting and the marketing people. And in the back, they have a warehouse, very often with 50, 60 employees who are making something, assembling something at tables. If they move and they go too far away from where they're at, they risk losing their employees. So there's a magic to them wanting to stay literally within walking distance because people are used to being there. So it's not that I found 37 deals easily. It's that I made maybe 2,000 cold calls to find 37 deals. So it wasn't drumming up business that wasn't there. It was finding the business that was there. And almost every company eventually needs to relocate for a bigger place or a different kind of a layout. The geometry in industrial is really important, how the docks are in one place and the manufacturing's in a different place inside the building. So it's really a lot about the layout. So someone might be in a building and they don't like the layout. They want to get more efficient to make more money. And I knock on the door and they'd say, hey, we got to get out of this place. We've been here for 10 years and it's the wrong place. And if their lease was coming up, I just latched onto them and got to know them very well.
No, I appreciate that clarification. I think it's helpful just to understand, like, again, it wasn't just that, you went down, a couple people wanted to move down the street because it was a better side of the street, but recognizing the challenges, sometimes good problems, right? If you're growing, you need more space, or again, the functionality of the layout isn't exactly optimal. That may be some of the reasons. For those folks who aren't familiar with industrial, right? Like as real estate investors, what would we need to know? I mean, give us kind of a one-on-one of investing in industrial properties.
Sure. So industrial properties are just boxes. If you drive down the highway, if you could drive down the tollway in any city, whether you're in Cincinnati or Cleveland or Chicago, you drive down the highway or the tollway, and if you look out your window, you see these giant, beautiful precast concrete buildings that are usually, they have stripes and they have medallions and they have offices in the corners and just a line of truck docks. Those are called Class A buildings. And those are primarily owned by institutions, by pension funds, insurance companies. That's not what I do. That's where you or a Target warehouse or something like that. What we do is called Class B and C, smaller buildings closer to the city, close to the airports. That's called infill industrial. Buildings are about 20,000 feet, 30,000, 50,000. And the companies that occupy them just run the gamut between manufacturing food, anything you have in your house or anything that you see outside of your house in any place was manufactured someplace. At some point, whether it's made in China or India or in the United States or Mexico or wherever, it ends up being distributed from someplace. So the kind of properties that we concentrate on are basically manufacturing buildings where it's an entrepreneurially owned company started by some guy or some guy and his sister in the 1950s. And now there are three sons of one side and a couple daughters and the sons-in-law, and they're all in the business together and they're making millions of dollars. And generally they get along, but sometimes they hate each other. So there's a lot of psychology in me when I work with people who are tenants. And it's been a blast because I see companies that make things that I've never even heard of before, products that go into other products. We had a company that was a magnet manufacturer, 200 employees. Everything has a magnet. Your computer has a magnet. Your lamp has a magnet. Your car, the planes, everything. And they were making them in our building. It was fantastic. And we had another company we still do that makes exhibits for children's museums. Just so many different fascinating companies, and the people who own them each have a story. So what I do is I find buildings, still by cold calling, by the way. I have people, including my 27-year-old son, who go door to door to ask people, hey, would you consider selling your building? And that's generally how we find them. And then we figure out what they're worth. And if we buy them, we keep them leased. If the lease comes up, we find a new tenant or we sell it. And it's a cycle. It's a cycle that manufacturers and distributors go through. It's a life cycle of starting the business, building it, potentially selling it to a much larger company. And then if we own the building, we end up getting the credit of the company that bought them out. By the way, General Motors was a tenant of ours.
Oh, nice. Nice.
You name it. We had Maytag, we had Comcast, but we have all these little companies owned by people who live nearby where the buildings are.
Yeah. You gave us a lot to unpack there. So one, I want to recap some of what you said, right? So first of all, you mentioned infill industrial B and C class properties is what you focus on. So these are going to be closer to the city core, maybe closer to the airport, where it's 20,000 and maybe 50,000 square feet. So not the big, huge properties, but more 20,000, 50,000 square feet is kind of where you're focused. And many of these are owned by families. You mentioned entrepreneurs who launched a business maybe in the 50s or 60s, and it's family owned. And you're still finding these deals by, cold calling, knocking on the door, and having these direct conversations. So I want to start by just, again, going into that more, finding the deals. in the multifamily, and that's the lens a lot of our listeners are going to have is, finding multifamily deals. Well, for them, obviously brokers are really big, brokers, wholesalers, other investors. That's the primary way to come across deals here. Sounds like you're doing a lot of cold calling to find these deals. So a couple questions. One, are there brokers who focus and specialize on industrial? And then two, when you're talking to people, are you talking to like that original business owner and buying them out, or are you buying it from another investor where there is a separate tenant who is actually running a business in that facility?
Wow, that's a series of good questions. So let me give you a couple stories, and that'll probably answer this for you. In 1974, a fellow by the name of Bob Steiner worked for a company that made safety products for the welding industry. Very specific niche in Chicago, in the city. And they were in a 50,000 square foot building. Bob was promised a piece of the business by the couple that owned it. It was a husband and a wife. And when he went to them after several years and says, "Hey, it's time for you to bring me in as a partner in the manufacturing business," they told him they changed their minds. So he went and started his own business competing with them, making safety products for the welding industry. And he was running their business, so he knew how to do it. He rented a small little industrial space in the city. He hired a few people. They started manufacturing. They started doing well. He built the business up over a number of years. And then he bought a building at 5801 North Trip, which, by the way, is the street on which Walt Disney was born, in case people didn't know. Walt Disney's from Chicago. So 5801 Trip is a 33,000 square foot building, and he bought it in 1995 when the company had grown. He kept building the company, and the company was selling, let's call it $15 or $20 million worth of products. He had about 50 or 60 employees, and he was approached by a company on the London Stock Exchange called Bunzl that owns 70 manufacturing companies in the United States and Canada. And they offered him a number of millions of dollars, and he ended up selling the business to them. And they kept the building because it's hard to move. Companies don't like moving, and they leased it back from him. We got to him when they had been there for a number of years, and he was tired of being a landlord. He has 2 kids, 2 adult children. They don't own any other real estate. So by networking, I found Bob, and I said, "What do you want to do with this building?" And he said, "Sell it to you." So I looked at the lease that he had signed with Bunzl, which is the company that bought him out. And I said, "This is great. We're making an 8% yield, 8% cash flow on the lease." And based on that, I agreed to buy the building from him. And we agreed to pay $2.25 million for it. And we did our due diligence. We were very careful. We looked at the roof, and we looked at the parking lot, and we looked at the credit of the tenant. We made sure Bunzl was a real thing, which they are. They're a $12 billion company. And we bought the building, and I went out and I syndicated it to a group of 40 people, and raised most of the money. I did not raise all the money. What happens is I buy the building first. I have one group that puts up a certain number of millions of dollars with me, and we use that to buy the property. And then after we own it, then I syndicate it to those people and their friends and other people that join our group. So we've been raising money for this Trip deal, and I've raised $2 million, and I've got just a few $100,000 more to go. And when people say to me, "Hey, I'd like to invest in Trip," I say, "Yeah, I don't want you to invest too much in our first deal, because then I don't have room to add more people, because it's all the relationships that get started that turn into something better later." So we're still looking for investors, but on a very slow and steady basis.
Yeah.
And that's
you already
typical,
own it.
yeah. There are brokers, to answer that question. There are brokers.
Mm-hmm.
There's a group called the Society of Industrial and Office Realtors, and there's thousands of brokers around the world that belong to it. I'm a member. And in Chicago, there's a group called AIRE, AIRE, the Association of Industrial Real Estate Brokers. And in Chicago, there's about 300 active industrial brokers. And we, out of the 100 buildings we bought, have bought 5 from brokers and the other 95 off market that we discovered through cold calling and so forth.
There you go. So primarily using your own direct to owner efforts, cold calling, building those relationships. But you do have some broker relationships where if a deal falls in your lap, you'll certainly take advantage of that.
Yeah. At one time, we had a telemarketer calling to find buildings, and he had a disability. He had no memory. Literally, he couldn't remember anything.
Wow.
But he could pick up the phone and call people. And if his name was Dan, they said, "Hey, Dan, shut up and never call us again." He'd hang up and call the next person because he didn't remember that they gave him a hard time.
Wow.
So for 5 years, Dan made probably 100 dials a day and found us building after building to buy.
Well, there you go. It's good to have a Dan on your team. So I want to break down a little bit more, right? So appreciate you giving us the context of, how those deals are being found primarily through cold calling and building these relationships. And you started getting to a couple of things that are a little different and unique, I think, for the industrial space. One, you mentioned that you got a credit of company. What exactly is that? And talk a little bit more about when you're going through that due diligence. Obviously, there's rent that's paid, and taxes and stuff like that. But what are some of the other things you're looking at as far as the business plan, how you actually make money, and what you're looking for in the deal?
Sure. So unlike apartments, where you might have a multi-family building with 8 units or 100 units, we generally buy single tenant buildings. There's one tenant. So either we are 100% leased or we are 100% vacant. And 100% vacant sucks because vacancy is really our biggest risk. What happens is when we have a vacant building, when our tenant moves out, or when we buy a vacant building, which we sometimes do, we have to make a decision when a tenant is interested in leasing from us as to whether we want them or not. So we always look at their financial statements we determine it's not really their credit. It's really their financial wherewithal. How much money do they make a year? How much debt do they owe? Really interesting one is how many customers do they have? If they've only got 2 or 3 customers and they lose one, they could go out of business. So we had one tenant that was a bottler of water, and he had 70,000 customers. We like that. We had a printer, and he had 3 customers, and the biggest one was a stationery company, and they, after 50 years, terminated their relationship with him.
Wow.
And they ended up having to go out of business, and they moved out of the building. So we had a vacancy. So we check on many financial factors before we sign a lease with anybody. And sometimes the answer is no, we can't make a deal with you because we like you, but we can't do business with you because if you move into our building and we take the risk, we take it off the market, and maybe we paint the office and put some carpet in and maybe give you a little concession, some free rent to make it easier for you to move in. When you move out, we're stuck. So we do check on their financial statements, and we call a tenant that's got good financials, we call that a credit tenant. And they're rated just like companies are rated, like GM is rated and like Ford is rated. They're either A or double B minus. So we can look them up. And if they're
Joe, where do you look that up? Is there a database or something you use to find that?
Yeah. Most of the largest companies we deal with are public. So all of their financial statements are actually on the internet because they're required by the SEC to make them public. If you're a stockholder in a company, you can look them up. We had AT&T in one of our buildings. They're still in a building of ours, and they tricked us. They gave us a company called AT&T Services, which is not AT&T. It's a smaller company that if they ever sold the company off, we wouldn't have AT&T anymore. And we really never had AT&T. We had their local real estate division. When we did a deal with Comcast, we got a guarantee from the parent company in Philadelphia because what we were getting was something called Comcast of Illinois. So we just want to be super secure. The tenant pays the taxes, the insurance, the maintenance, and the utilities. And if we go like a year and it's a company's got financial problems, they don't pay the taxes, we get stuck having to pay a tax bill and the penalties. So it's a very credit-driven decision in terms of our due diligence when we lease up properties. When you lease an apartment, yeah.
Yeah, no. So to that point, these are publicly traded companies for the most part. What resource are you using to find out, kind of their credit status? Do you have one that in particular that you use?
We actually just get their financial statement from them. We ask them for it and we give it to our accounting firm, and we have the accounting firm write up a one-page synopsis of whether it's a good risk or a dangerous risk.
Got it. That's helpful. And I think it's important to understand because, I know that some companies, like if you watch, MSNBC or Fox News or any of those, they'll tell you that, oh, this company was downgraded or upgraded. And there's certain firms that do that. So I wasn't sure if there was like a specific, Moody ratings or anything like that in particular that you use. So it's really helpful people to understand, how to qualify and quantify whether or not a company's credit rating is suffice.
And I'm sure in multifamily, it's similar because you can do a credit report and you can check people out and you can get references and so forth. I mean, it's the same kind of thing. It's just on a much different scale.
Yeah. Yep. Is there anything that is just different or unique about industrial, whether it be compared to other triple net lease options or even multifamily, that someone who is really interested in this space would need to know before they went much further?
Yeah, industrial, I've been doing industrial for 40 years and it's changed a lot. Industrial used to be a sleepy little part of real estate that nobody heard about. If you went to a retail store and you'd see like Bed Bath and Beyond, or you'd see some sign like Macy's or whatever, that's clear to see when you drive by on the street. Industrial buildings were always hidden behind Macy's and behind Bed Bath and Beyond. You couldn't figure out where they were because they were on little streets that you didn't even know where to get to them, called Industrial Drive or some other name that the developers often name streets after their kids. So there's a Bonnie Lane and a Randy Road, and every industrial park, if you go there and you see the first names, those are the people who developed the park's family members. So these industrial buildings are behind things, and they're generally the ones we buy. They're brick buildings that were built in the 1960s and 70s, and they're just a box. It's a roof with a certain ceiling height. The higher the ceiling, the better. Parking is very important for all their employees, and the truck maneuvering room so that the big semis can back in and out with their pallets that they move in and out of the building. So it's a geometry business and it's a hidden business. But because of Amazon and because of Target having online sales and Wayfair, it's amazing that the buildings have changed in terms of how they're built, how tall they are. And we leave that to those pension funds because they get a 5% return or a 4% return. Cap rates are very low on the big buildings that are leased to big companies. We'll take shorter leases. They won't. We'll take a 3-year lease and be glad to have a 3-year lease, thinking that the company's probably never going to move because it's too expensive or too difficult. And generally, industrial buildings, I think the greatest thing about them is when tenants move out, you don't have to do anything. It's got a little office in the front. We made a deal with a guy who was on Shark Tank. He was on Shark Tank year one, and he makes protein bars. It's called Element Bars. He's at 2700 Roosevelt over near where you used to live in Chicago. And he's got 50,000 feet, started the business from scratch. And he moved into this 50,000 foot building. And when I met with him, he said, "When can I move in?" I said, "When do you want it?" He said, "Next week." So we negotiated a lease and he took the keys, and it was as is. He put in the new carpet. He painted the walls in the office. He sealed the floor for food manufacturing in the back. He built all these rooms to make sure that peanuts weren't getting mixed in with chocolate for people who have allergies. And he put in air conditioning, and he did it all himself. And he paid for it. That's industrial. Industrial, in my mind, is simple, simple, simple. Let the tenant do it all. And it's the greatest feeling. You walk over and you knock on the door, and Jonathan says, "Come on in. Let me show you what I did." and he's improved our building and he starts paying the rent. That's industrial.
I think the thing that's really cool is that, what I'm hearing the advantages are is that, first of all, the leasee, they're doing all the work. They're fixing the property up. They're going to make it their own. You want to obviously make sure they have a strong, credit situation, great financials so that they can be there and be there long term. That way, you can continue to make money. The biggest risk is obviously the vacancy. If they either can't pay or they have to leave and you can't get someone else in there, that's going to be the biggest risk. But little work for you as the owner, because they're going to be the ones who are taking care of the property itself and making it fit their needs. So lots of great information. One other thing I want to get into before we go to a round of insights is you pay cash for your properties. And lots of people look at that, and given the current situation with interest rates going up, they may say, hey, you know what? There's some cheap debt, or at least there was cheap debt, but you have a philosophy to use cash. Talk to us a little bit more about why that is your philosophy.
Well, it comes down to mental health for me, actually. In 2008, I hit my fourth down cycle. Over a 40-year period, I've seen a lot of ups and downs in the economy. I had 50 buildings, I had 300 investors, and I had bank debt at 7 banks when the economy cratered and the big economic crisis happened. And 7 banks came after me. Tenants moved out of buildings. We had to keep paying the mortgages. We owed $100 million, and I had personal guarantees because banks require personal guarantees most of the time. There's not a lot of non-recourse at banks. So I ended up on the couch in a severe depression because I thought I had lost everybody's money and that it was going to be this big implosion of my entire portfolio. And I realized after that a lot of debt, especially with single tenant industrial buildings, is very much like gambling in the casino. Because if something goes bad, the house wins. And in the case of real estate, the house is the bank. Banks never lose. And I decided that if I ever have mortgages again, they're going to be very small. So our total loan to value ratio on any building that we ever borrow on is going to be a maximum of 30%. And we raise the money from investors to buy buildings all cash, and I prefer to keep them that way. That way, anything that goes wrong, we can handle it. And I sleep well at night, and my investors sleep well at night. And there's a group of very wealthy people who just don't want to lose their money. What's the old expression? How does that go? How do you turn I don't remember the joke, but it's about people who start with a lot of money end up with very little because they made stupid mistakes, which was taking too much risk because they thought they were geniuses. Because if you buy buildings and it works and it works and it works, you think it's going to work the next time. But then when the economy changes or interest rates go up, it may not work anymore. So these all cash investors are people who I think don't want to be risk takers and are afraid to lose what they've worked so hard for. I've got multi-millionaires and billionaires, and you'd think, well, they would take more risk because they can afford to. Let's borrow at 3%. They really like the all-cash model, but it's a ton of work because I have to raise more money and explain it to more people and hold more hands, but that's my favorite part of the business.
Hey, man, I love the fact that you found a model that works. And to your point, you have to understand the goal for your investors. And when you're dealing with those higher net worth investors, they're not necessarily trying to make a bunch more money. They're trying to protect the money they already have. So reducing risk is certainly the game plan there, and it makes a lot of sense. We are going to move on to a round of insights, but I want to thank you for all the great details you shared on the industrial business and your approach to using cash to acquire these properties. All right, first question here. Give me a failure or an apparent failure that set you up for later success.
Oh, well, I would say that I did something really stupid. I borrowed money using promissory notes from 60 people who trusted me, and I guaranteed all those notes. And I was paying a high rate of interest. I was paying them 10%. And in 2008, in addition to 7 banks, I owed 60 people millions of dollars. It was the dumbest thing I ever did. When I see people borrowing a lot of money and taking risk and just going right to the limit, I say, I learned that lesson already. I'm not doing it again. And maybe they'll be successful and maybe not, but I just can't ever do that again.
No, I appreciate you sharing that. Give me a digital or mobile resource you recommend for your business.
Okay, Josh Spector. Josh Spector is somebody who has a weekly email that he sends out. It's a newsletter, and he provides very interesting content to content creators. I think in our business, like what you do, you're creating content all the time. This Josh Spector, he does something called For the Interested, and he talks about blogs and he talks about podcasts and videos and articles, and it's the most, he's fantastic. If you watch him one time on a podcast, you'll subscribe. He's the best.
I love it. We'll make sure we link to that. All right, give me the book you've recommended or gifted the most in the last year.
There's a book called The E-Myth, which was written by a guy by the name of Gerber. And what it says is that entrepreneurs start a business thinking that it's going to work for them, and they end up working for it. And the business becomes their new boss. They're not in charge, the business is, and they hire people, and they're never satisfied because people don't do what they're supposed to do. And the E-Myth explains how you set up systems so that you get the ownership dividend of owning the business so that you can be the owner and be happy, as opposed to being miserable, stuck in a business that you didn't understand was going to be a disaster for you later.
All right, give me a daily habit that helps you stay focused on your goals.
I talk to my mentees. I mentor people, and I'm also mentored by some older guys. I'm 63. I have a guy who's 78, and I have a guy who's 95. And I have a group of investors. I make it my business to talk to at least 3 mentees, mentors, or investors every single day.
I love it, man. It's a great one right there. All right, give me your number one insight for industrial investing.
Well, I think there's going to be a crash. I think it's been too good for too long. And I'm kind of taking a break right now. So my number one insight is be careful. Anything you buy in industrial right now is probably overpriced. We're having trouble finding properties to buy. And this is not a great time to jump in, except if you go so low risk that if things go bad, you can still survive it, which means in our case, this is why we're doing the deals all cash. Leveraged,
Makes a lot of sense, yeah.
Leverage, you could lose a lot of money if things go bad.
Yeah, appreciate that. And that makes a lot of sense. Let's lighten the mood, right? So I know that, Chicago or Chicago area was home, and I believe you still spent some time there. Give me your favorite place to grab a bite to eat.
Charlie Beinlich's in Northbrook. It's a hamburger place. It's been there since the 1950s. I don't know what they put in the burgers to make them so good, but I think they throw butter in there. I'm not sure, but they grill the burgers and then they put cheese on it. So it's a cheeseburger with these grilled onions. And I think they must put sugar on the grilled onions to make them sweeter. And then they grilled the hamburger buns in butter. It's fantastic. It's the greatest. There's a line out the door, and it's just it's a bar. And you feel like you're walking into the North Woods of Wisconsin. It's a fantastic place.
Well, there you go. We make sure we link to that one in the show notes as well. Listen, Joel, you gave us some great insights on, what to look for with industrial. I particularly like the cold calling nature and the fact that you keep that approach. You're looking for off market deals. 95% of the deals are coming from those daily efforts, whether it's, your guy Dan or your family, yourself making these phone calls, still kind of going that way and building relationships. And I think that's just the key takeaway, is at the end of the day, this is a relationship driven business. And listening to you talk about, some of the buildings you've acquired, you shared stories of those businesses and how those businesses came to be. And you can tell kind of the connection that you had with those business owners. And that probably makes it much easier for them to want to sell to you and for you to acquire these properties. So just really good insights that I hope our listeners can take away and kind of implore, whether you're thinking about industrial or not. I think that that level of connection it's really important if you're looking to go directly to the owner and build relationships and get some off-market deals. And then your last point that I want to take away or point out here is, using cash as much as possible, lower leverage. That's going to just reduce your risk and take some of that mitigation or take some of that risk off the table. So just another good way to think about it. Mental health is the most important thing. Take care of yourself. And, that's one way you can help yourself there. Joel, again, for those who want to learn more about you, your website is britproperties.com. That's BRIT properties.com. And you can check out Joel and his team more there. Joel, I want to thank you again for coming on Multifamily Insights. I hope you have a great day, and we look forward to staying in touch.
Thanks, John.